Canadian banking regulators' subtle clarification may trigger housing market sell-off. In a recent article by Daniel Johnson for BNN Bloomberg on September 15, 2023, the Office of the Superintendent of Financial Institutions, OSFI, has addressed concerns regarding extended mortgage amortization periods in Canada. The OSFI is a regulatory government agency responsible for overseeing federally regulated financial institutions in Canada, including banks, to ensure their financial stability. Reports have surfaced indicating that some Canadian borrowers are opting for mortgage amortization periods far exceeding the typical 25 years, with some even stretching to as long as 90 years. This trend has gained attention amid rising interest rates and economic pressures. OSFI has now clarified its stance on these extended amortization periods, asserting that they do not accurately represent a borrower's actual repayment period. The agency emphasized that these extended projections are hypothetical calculations based on the assumption that the borrower will continue making fixed payments for the entire loan duration at the current interest rate. Importantly, they do not alter the borrower's contractual obligations. Daniel Viner, the principal broker at DV Capital, noted that despite claims of mortgage terms extended to 70 years or more, these lengthy periods are not realistic and do not reflect the actual repayment period for borrowers. Viner emphasized that the days of extend and pretend are coming to an end as borrowers approach maturity. OSFI's statement aims to provide clarity to consumers regarding their mortgage loans, dispelling the misconception that banks will not take action at renewal. Viner suggested that homeowners caught off guard by the need to reset their amortizations at renewal should proactively discuss the issue with their lender. The article further highlights that borrowers falling into this category have options to manage their debt loads in the face of elevated interest rates. These options include increasing mortgage payments, making lump sum payments, and renegotiating their mortgage terms. However, Viner expressed uncertainty about the feasibility of increasing mortgage payments and noted that the scope for renegotiation is limited, with only minor adjustments likely to be made to the current interest rate. In summary, the OSFI has weighed in on the trend of extended mortgage amortization periods in Canada, asserting that these lengthy periods do not reflect borrowers' actual repayment timelines and should not be seen as an indefinite option. Borrowers are advised to discuss their mortgage terms with their lenders and explore options to manage their debt in the context of rising interest rates. How this clarification by OSFI could collapse the Canadian housing market. The subtle clarification by the Office of the Superintendent of Financial Institutions, OSFI, regarding extended mortgage amortization periods has the potential to trigger a series of events that could lead to a collapse of the housing market and an influx of houses for sale, ultimately driving down property prices. How this could happen. Higher monthly mortgage payments. OSFI's clarification essentially underscores that extended mortgage amortization periods are not a sustainable or legally binding solution. Borrowers who have been relying on these extended periods to afford homes with higher prices may suddenly find themselves facing significantly higher monthly mortgage payments at the end of their current terms. This can be due to several factors, including the need to reset the mortgage terms and potentially higher interest rates. Financial strain on borrowers. With higher monthly mortgage payments, many borrowers may experience financial strain that they did not anticipate. These increased payments could lead to a situation where some homeowners can no longer afford their homes or may struggle to make ends meet. This financial pressure could force them to consider selling their properties. Increased supply of homes. As borrowers who can no longer manage their mortgage payments decide to sell their homes, there could be a sudden influx of properties onto the housing market. The increase in the supply of homes for sale can outpace the demand, creating a buyer's market. This shift in market dynamics tends to put downward pressure on property prices. Falling property prices. The combination of increased housing supply and lower demand can lead to falling property prices. When there are more homes available than there are willing buyers, sellers may be compelled to lower their asking prices to attract buyers. This price correction can further erode the value of homes. Negative equity and foreclosures. For homeowners who purchased properties at elevated prices and face declining property values, there's a risk of negative equity. Negative equity occurs when the outstanding mortgage balance exceeds the market value of the home. In such cases, homeowners may have difficulty selling their homes without incurring substantial losses. In extreme cases, some may face foreclosure. Market uncertainty. A sudden influx of homes for sale and declining property prices can create uncertainty in the housing market. Prospective buyers may adopt a wait-and-see approach, anticipating further price drops. This can lead to a stagnation in the real estate market, with fewer transactions taking place. Impact on the economy. A housing market downturn can have broader economic implications. It can affect consumer confidence, reduce household wealth, and impact the construction and real estate industries, which are significant contributors to the economy. A slowdown in these sectors can lead to job losses and economic instability. Policy responses. In response to a potential housing market collapse, government authorities and central banks may take actions to stabilize the situation. These measures could include interest rate cuts, mortgage relief programs, or regulatory changes. However, the effectiveness of these interventions may vary, and they may not prevent a significant correction in the housing market. In summary, OSFI's subtle clarification regarding extended mortgage amortization periods could set in motion a chain of events that leads to a housing market collapse. Higher monthly mortgage payments, financial strain on borrowers, increased housing supply, falling property prices, and economic repercussions are all potential outcomes. It underscores the importance of borrowers, lenders, and policymakers being vigilant and prepared to respond to changing market conditions to mitigate the potential impact on the housing market and the broader economy. What do you think? Will this clarification by OSFI result in increased mortgage payments that will force a wave of selling and plummeting prices, or will homeowners simply pay the increased payments until such time as prices are again on the rise? Please join in on the conversation by leaving a comment. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.